Hello everyone. I'm just gonna give me 1 minute before anyone else joins. That way I can make sure other people can join and they can enjoy the live stream. I was gonna stream yesterday, but I decided not to because I'm going on a bit of a trip tomorrow. So I'm just hoping that I can work towards basically getting this slideshow done. I did just today actually. I spent a decent amount of time on it today, and so I feel like this slideshow would offer a bit of value on like how to invest and everything. But I wanted to also show you my face cam to make sure that you can see basically what I look like and everything. And plus I did a quick change to my setup. I have like a little light. So now I think I look a lot better with this new light setup versus without it on. I feel like I glow a lot better with it on. So I feel like this light setup is a very good addition to my streaming setup. Oh, I'm watching my own YouTube video, Lamau. That's funny. Yeah. So today, sorry about the delay today, but today we're going to be covering basically a quick slideshow about some more investing topics for the income portfolio series that we're going to be doing. And also I want to cover I want to go into buying the equities and then holding it for maybe a few years and then see if I can do well with that. And then after that, I want to save the game and then come back maybe next week and then make more slides and everything like that. Because I feel like it's very, very interesting making these slideshows. So, like, let's just get it started. So today, we have the Income Portfolio Episode 3, which is interesting. So, slideshow from... There we go. So now you guys can see it. That's pretty handy. So I made like an income portfolio. We're going to be playing Roinsoft software. We're going to be playing Speculator today. So the disclaimer, basically I'm not a financial advisor. I just really enjoy making financial advising content and everything. But like anything I give in this game, any tips or anything, I would say talk to it with your financial advisor or do DIY, do it yourself. But make sure you use me kind of as like a toolbox and use the things I taught as a toolbox, and then you learn how to use those tools to the better of your degree, and then you're going to be good with that stuff. So like if you have any financial concerns, just please see a licensed professional because they're going to know a lot more about your current situation than me. And the software we're going to be playing is Roinsoft. So like this is for example Wall Street Raider. So it's a very outdated website in my opinion, but it is a very, very good game, and you can get Speculator. Today we're going to be playing Speculator, and I'm going to be teaching a bit about portfolio management through like income. And that's why I've done all throughout the entire 2 episodes and everything. So today's episode, I have a bit of an agenda too. Today's agenda is basically going to be about the revisions from the after-tax cost of debt. So last episode, I made a mistake with the math. I made the math look like it was a lot better. Like the return, like for example, you get 9% on a bond and you pay tax. It's 10% after tax. No, that was completely wrong. I apologize for that. But I did search up like after tax cost of debt, and I know the formula for it now. So I add that to the slides as a revision. And then we have the rule of 72, basically the rule of compounding, how long it takes for your money to double. And it's a very, very interesting rule. And then historical prime rates as a comparison to show in Wall Street Raider, like when do you usually buy bonds or when do you issue bonds generally. And then highlight of it will be the 5 categories of financial ratios, industry demand and optimal capital structure. And then we're going to end it off with specialty exchange trade funds. So I find that this episode is going to be very, very interesting. And so like basically one thing I found very, very interesting about Warren Buffett, and he said in the past, when he was a younger investor, he did have a concentrated portfolio of a few stocks. So he did outperform. But that is taking a lot of risk in my opinion, and I'm not much of that type of guy who does that in real life. But I do understand that like people that want to make big money, they have to like keep a very, very concentrated portfolio in order to make better alpha. But what if one of those picks of 5 go down a lot? Well, like you're not making much alpha, and you need lots of capital in order to buy the dip on that stock. So in my opinion, I'm more of a value dividend investor, but I am thinking about going more into growth stocks in the long term and actually having a bit more of a concentrated portfolio. But right now I have like a lot of stocks. I would say I'm probably near the point of being over diversified because I have core and satellite. But volatility basically doesn't matter. You basically want to make sure that you don't lose permanent losses of capital. So bankruptcy or insolvency. So like for example, like you want to avoid using margin to make sure you don't go into debt and then you don't go bankrupt. Or a company has too much debt, they can go bankrupt, and that's a permanent loss of capital. Whereas a company that's quality has a bunch of cash, they can do a lot better because they have enough cash to wait it out. And if it goes down a lot, it's a good time to buy a quality business. Whereas if basically you just want to, volatility isn't really risk. It is risk because like you lose money or you make a lot of money, but in the long term, volatility doesn't really matter. It's all about trying to get rid of permanent losses in capital. So today, we got our 3 things right here. We got the after cost tax of debt, Rule 72, the prime rates in Canada, where they historically were. And like, for example, in real life, if you think historically, I'm going to go into that a bit more detail later, but like right here, we got like the after cost of debt. I got this from like Investopedia. And another source would be Speculator. I forgot to add that in. But basically, in order to calculate like the bond yield on a bond, it's usually the risk-free rate, which is like the T-bill rate and stuff like that, plus the credit spreads. The credit spread is like how much extra risk the company has taken. So like, for example, if you issue a lot of debt, you're pretty sure you're going to have a high credit spread because like you're insolvent, or like there's more chance of becoming insolvent or whatever. And then you just do times 1 minus tax rate. So for example, a corporation pays a bond right here. So we have a bond of 5.75%. And basically it's a 5.75% bond times, you do 1 minus 0.21. So you just do 5.75 times that number. So like it'll be 1 minus that. You get 4.54% after tax cost of debt. Because a bond and variable rate debt in this game can be deducted away from your taxes because it's interest that you're paying, and it comes out of like, well, it goes like your revenue, your cost of goods sold, and then a bunch of other things. But interest is like one of those first things that you pay, and then after that comes for your profit, like your net income attributed to shareholders, and then after your net income, then is when you get your profit per share or something like that. Video capture device. So I'm going to turn this off real quick. An interesting fact that I learned from Business 2 when I was in my class, preferred shares are basically pay dividends instead of interest, which is after tax income, so they cannot be used for tax deductions. So one thing I found very interesting is if you're buying preferred shares IRL, it's way more expensive than issuing bonds, and sometimes could be more expensive than issuing equity, just because you cannot deduct the interest on preferred shares. But sadly in this game there is no preferred shares, so there's only bonds and convertible bonds and stock and futures and a bunch of other complex stuff. But I like playing this game. So for the investor, because this bond is trading at 56.52, basically the bond is trading below par. So the rate is actually 10.17. It's over here. So basically the bond is trading below par, so that makes it a very, very high interest rate versus the 5.7. But the 5.7 is being paid by the corporation because they have to pay based on par value. But because you're an investor and it's below par, you get a much higher yield of 10.17%. So you do 72 divided by 10.17. It would take about 7 years for you to double your money. That's why the TFSA matters, because the 10.17 is tax-free, whereas if we do the after-tax yield on the bond, 10.17 times 0.26. So 0.26, if you go in the game, there's tax rates and everything. So if you go into the tax rates, if you go into like the tax rates and stuff, you can see that. So we got 7.52. So it takes about almost 10 years to double in that case. So like that's why I like over time, the historical prime rate in Canada has been around, I would say, 4 to 6%. And during the 70s and 80s and early 90s or whatever, basically that's when I feel like the stereotype of your parents saying, oh, you need to save money for your thing. It's very good to save money, but interest rates were much higher back then, especially in like 1980 something. it was like in double digits. So if you put your money in a long term at like 13% rate, and it's relatively safe and it gives a good return, like your parents were better off. Versus us, we get like a 4 to 6% if we're lucky, and that takes a lot longer to double. Versus your parents, they could double their money relatively safely and easily. I don't know why it looks like my stream looks bad. I'm looking at it, it looks all grainy. Dang. No, it's not looking that grainy. Cool. So then we got that. So basically in the game, in Wall Street Raider, I really like to issue bonds around below 4 to 6 prime, or when interest rates are below 3 to 4 on the long or the short bond. Generally the short bond, because like usually it's a good time to issue debt. Versus most of the time I will have like a revolving business loan, just because I feel like that's a great thing in the game. So then here's a sample company, Sun Microsystems, computers industry. So like we can see right now, we did a little bit of math. I know I did a little bit of math and stuff to calculate like the 5 ratios and everything. So right here you can see the free cash and equivalents is 335. Working capital AR is 901. And then we look at like the capex and the cash flow statement is $43 million a quarter. And then we can see like later on in this statement, we can see the pre-tax operating margin and everything else. So as a replacement for the quick and the current ratio, I did 1 year of capex. So it'll be 172 million for this business to grow. So they're going to be spending about 172 million of their 335 million basically towards growing the business over time. So you want to make sure they have liquidity, which I'm going to go into a little bit more detail in a little bit later. And then the payout ratio is basically the dividend per share divided by the earnings per share of the last year. So it's 41%. It's based on last year's profits. So the problem with that is if profits all of a sudden take a dive, and I did test out this company, I bought the company, and then like a year later, they had a lot less than 81 cents a share. So their payout ratio is obviously above 100. So then the 5 quick ratios that we have are the liquidity ratio. So a very, very important ratio to search up like on Investopedia will be the current ratio, the quick ratio. So the quick ratio I wrote down over here, it excludes inventory. So that's current assets minus current liabilities. So the current assets are basically short-term assets that the company can turn to cash relatively quickly. So that being like inventory and just like accounts receivable and like cash they have and a bunch of other things. But like basically they can turn that cash and they can turn it to cash in like less than a year. So like that's why it's considered liquidity. And the quick ratio excludes inventory because inventory is generally sold for a discount if they're desperate. So it's much more better to use like the quick ratio. So if we use the quick ratio in this case, we just do like last thing, we did 335. It's right here. Yeah, we can see 335 divided by 172. So they have about 2 years worth of capex if they stay flat growing. About 2 years. Because like if they do $200 million this year in capex, then they're going to have a little bit more capex the other year because they contribute the other 200 million. But they're going to have plenty of liquidity to be able to grow the company. And plus, if you include the current ratio, like they got so much liquidity, it's crazy. I would say that like they're potentially underperforming because they're not using their cash towards buying assets that help make more money. But like having liquidity is important. Gross profit margin, they don't have gross profits in this game, but gross profits are basically your revenue minus your COGS. So your COGS being the cost of goods sold. So like for example, if you make $1 in revenue for selling an apple and that apple cost you 50 cents to make, like it's just like the raw cost of it, then basically it'll be a 50% gross profit margin. And then the net profit margin is basically the net income divided by the revenue. So basically it tells you how much dollars you're making for every sale. So like sometimes I've seen it as low as 1%. And so that means like basically every $100 they make a dollar in income in like net. And that dollar in net could be sent to you as a shareholder. So having a great good control over the profitability of your firm, especially the gross profit, Because after gross profit, I feel like most of it can be controlled. Like, you can control how much money you borrow. You can control how much money you pay in taxes potentially. So, like, the gross profits are things that you cannot really control, like the cost of goods sold. Yeah, you can find ways to, like, lower cost of goods sold, but it might hurt the quality of your product and stuff like that. And an efficiency would be, like, the return on equity, return on invested capital. So return on equity is basically the net income divided by the shareholder equity. It basically tells how well a company is using shareholder resources towards growing the company. So typically I look for above 10%. And then so like solvency risk, debt to equity and interest coverage. They don't have interest coverage in this game, or at least I'm naive and don't know how to calculate it, because I'm pretty sure it's EBITDA divided by interest expense. So if I went to the cash flow statement, and I could probably find the EBITDA, and I could probably find the interest expense, and then I could probably calculate interest coverage. And we got valuation ratios, which I cover the majority of the time, which is market capitalization, PE, price to book, payout ratio. So for this fake company, we picked out Sun Microsystems. They have a lot of liquidity. They have a decent pre-tax operating margin, but if you look at the ROIC versus the WACC, I saw that they had a variable rate loan. No data. Good. Oh, excellent. Okay, I'm back. Sorry about that. My internet keeps saying lagging now, I think. So like you can see that the ROIC versus the WACC. The WACC is basically a variable rate loan, and the ROIC is basically the pre-tax operating margin. They're using 5.10%, but they do not have a lot of debt. They have a decent return on equity, but I would say it's poor because it's below 10. Typically, you want to aim for like 10 or 20. And then market capitalization is considered a mid cap, because if it's above 2 billion and below 10 billion, it's considered a mid cap. So after 10 billion, it's considered a large cap. So large cap companies tend to grow a lot less than mid caps. Small caps tend to grow the most because they're small. Think of it, it's much easier to make $100 million than making $1 billion. So in that case, the trailing PE would be 22.5 times. I would say that this is average to high, because sometimes I think a low PE stock would be like below 14 times earnings, but a high PE stock will probably be like in the 30s or so. So I would say like this is average to high, so I'm a little bit skeptical about that. But like they also have a decent dividend, but they have a decent payout ratio. And the price to net worth, you're paying basically $1.42 for a company worth $1. So you're paying a little bit overpriced for the company, but I think some of these things in here are worth the thing, in my opinion. Like having a great credit rating and having decent times earnings, but like there's some pros and cons to this company that you can pick out based on what you see. And so like a hint, basically I usually look for companies below 14 times PE and below 1.5 times price to book. So this company would definitely qualify for the price to book, but it wouldn't really qualify much for the PE. So if the stock falls, or if they find a way to make more earnings, this stock could be a great value play. So right now we have different types of industry. We have different types of industries. So like, for example, this is very, very important to realize, because whenever you're investing in a company, you have to ask yourself, is it defensive, cyclical, or a bit of both? So in the case of defensive, tobacco companies are considered sin industry. So basically people need, like to a certain degree, people are very, very reliant on smoking. And so to a certain degree, it might be a great buy long term, because like, I don't know, then maybe. It's a sin industry. I don't really buy tobacco stocks in this game. Pharmaceuticals are great in the game. Beverages are decent. I never really do them too often. I like utilities and pharmaceuticals usually, because like those are things that people really, really need. If you don't take your drugs, you could die. Or if you don't take your utilities, you will freeze, or you don't have your AC going, you don't have that fan over there going. It's things that you need. And like supermarkets are another example, and household and personal products. Another name for that is consumer staples. So like, for example, your Procter and Gamble, your shampoo, your conditioner, you need that stuff. Whereas with a restaurant, it's optional. You don't really need to do that, and that's why they call them consumer cyclical. So like these are considered cyclical businesses because they have to do with like how good or bad the economy does. And so cyclical companies I tend to buy in this game often are restaurants, and I've tried furniture and appliances before. I've tried auto before. Haven't I've tried apparel before, but I like also airlines, but like they're very cyclical, so you gotta be careful about like whether or not you're in the peak of the economy or the bottom of the economy and stuff like that. So I find it very, very interesting that defensive companies, they're an alternative to bonds, and cyclical companies can be potentially an alternative to like growth companies. And so like for example, some undetermined or like a bit of both company industries will be global telecom, because if you think about it, to a certain degree, everyone needs their cell phone. And that's why I think it's very, very important to have like a global telecom in your portfolio or whatever, just because I feel like it's very, very important to have that. But it can be a bit of both, because maybe when people lose their job, they'll cancel their cell phone plan. But I would say it's a bit of cyclical and defensive, so it's a pretty good both play. Cyclical for software, just because I feel like during the slowdown in the economy, people aren't going to spend as much money on software and everything else. Footwear, I would say potentially is defensive because everyone needs shoes, but yet I have a brother that has like 3 or 4 pairs of shoes because he just likes collecting shoes. So I would consider that as cyclical in my opinion, because like it's both a need and a want. Housing development, that's very, very cyclical because right now we want to build a lot of houses because right now the housing market's hot. But if we go into a recession, people are going to stop buying homes, and so that's going to potentially hurt the housing market. Cyclical for integrated oil, because during recessions people probably drive less. They probably take airlines a lot less. They travel less. So that's why oil is considered cyclical. And security brokers, I'm not too sure, so I'm just going to leave that blank. But like here's like the optimal capital structure. I learned this a while ago, but for utilities, you want to look for a maximum of 50 to 70% debt to equity. 30 to 50 for oil and gas, which is medium risk. And high risk would be airlines. And in the game, I usually do 30 to 50 maximum debt to equity because I don't want my company to go bankrupt. Because if they go bankrupt, that's a permanent loss of capital. So Wall Street Raider guide, basically, I like to always issue bonds in the game. And I like to play around with the debt to equity. Like, for example, if I'm in, like, oil and gas and I want to play really risky, I may go above target, where I may go above 50%, and then see how much coupon I'm paying, see what credit rating I am. If I'm at a bad credit rating and I have to pay a very, very high coupon, I'm not very, very interested in that. I'm more interested in issuing at least triple B debt, but at I would like to do A debt, or AA debt, or A debt. Triple B debt is pushing it, while A debt is like pretty safe. So like I usually try to avoid cyclical companies with lots of debt. So you want to watch out on how much the company is growing, because like if they have a high growth percentage, like I said earlier with the capex, I think this company had like a 3% growth rate in the game, so that makes it 43 million. But if they had a higher growth rate, they will have more capex. And then therefore they would burn through this liquidity a lot quicker. And that's why I'm a big skeptic about companies that don't have a lot of liquidity, because they need that liquidity in order to continue to grow. So then did we do that? We did this. So then we got specialty ETFs. So basically there are 3 different types of ETFs that I would consider specialty, plus Bitcoin and Ethereum, and there's also a government bond one. But these are considered speculative funds that the creator, Michael Jenkins, I believe his name is, he created these 3 new funds in the last few updates. So we got the aggressive growth shares, so it's a 3x leverage fund, and the exposure basically it tracks index and is not suitable long term. That's because they use leverage exposure, and they use leverage basically. So like they use 3 times leverage on their money, and so like this is not very, very good for like short term, for long term, because they're using leverage, aka debt, towards buying shares, buying futures, and then if stocks do really well, they make like 3 times as the reward of a regular ETF. But the problem with it is, it's like a leverage or debt is like a double-edged sword. If you buy a lot, and then you can make a lot, or if you buy a lot and it doesn't do well, you can lose a lot. So I usually don't tend to play with these very much in the game, but they are there. You can use them, and you can make good money doing them in the game. Ultra leverage short index fund. So it's basically a 3x leverage. So both these use computer algorithms in the game, which I find is interesting, but they're both risky. So the inverse basically means opposite, aka short. So this one shorts the index. So if you think that the market is going to go down, you do a short one, and if you think it's going to go up, you do a buy. And one thing that I found is interesting is there's with the ETFs, when you buy an ETF, I believe you can only lose 100% if you buy it up outright. If you're doing like options on the ETF, then you can lose more than 100. But if you just buy it with your outright money that you have, you can lose 100% at most. Whereas if you do it DIY and you use leverage, you could lose more than 100%. So that's why I think it's nice to have these funds in this video, just because I find them interesting. So like an alternative to shorting or doing options, we'll be doing these 2 leverage ETFs. Short term though. And then a high income bond fund, I would say would also be good short term. Basically, they don't have capital gains because they pay their dividend to shareholders. And this one buys below BB credit, sells at D grade bonds that mean default, and then they sell at above A grade credit. So I'm guessing it buys a lot of triple B and a lot of double B debt, maybe some single B and some triple C debt. But after triple C, I'm guessing they play a little bit cautious with that stuff. But like you can see like the dividend yield, and you can see the debt to equity and stuff, which is very, very interesting. So the summary, leverage funds, basically there. It offers a cheaper and a better way to DIY your portfolio. Blue chip fixed income, prudent shares, government. So like those are your alternatives if you want something a little bit more safe in the game. You can do blue chip fixed income, prudent government securities, or a regular ETF. So a quick summary about everything today. So revisions and extras. Extra cost of debt is good because I can deduct the interest. And liquidity is very important because it basically, if it's above 1, it means that they can pay their short-term debts. If they can't, they may go insolvent unless they have bank loans or a bond issuance to counteract that loss. But there are companies in this game that have like no unused line of credit, and I've seen that have gone bankrupt. So like they always have problems with liquidity. Profitability, operating margin, you want to look for a decent operating margin, maybe above 10%, I'd say, because then that means that your capital assets, like your machinery, your inventory, etc., they're making good returns. But like in the case of this company, they're not making much returns to shareholders. So that's very important to consider: the operating margin, the gross profit margin, the net profit margin. We got efficiency, like the return on equity, solvency. So like use the optimal capital structure and go below, ideally, to avoid bankruptcy in the game. Valuation, you want to use the price to earnings ratio, which is basically how much you're paying for a company, like how much dollars you're paying for a company's earnings. Industry demand, know the difference between cyclical versus defensives. And alternative to DIY can limit losses. So like that's the advantage of having special ETFs. That's it for the slideshow. Okay. I have a little note thing that's telling me things to do. It's fun. But like we have our thing out. Let's get Speculator out. So what we do is we hit open save game. Okay, so we got our account balance. Last time we left off 238k. And I'm gonna do Speculator. Let's set up our setup. So we do this, I think. I do MISC, streaming quotes, commodities. I put this over here. And over here. So here we go. We got our quick little portfolio. So last episode we left off, we basically rebalanced our portfolio a large amount. So like if we actually look at like this percent or whatever, like the percentages and stuff, like if we get our calculator out, this is a little bit tedious, but I'm just double checking. Oh no, we're going to divide that by the total equity. So we have about 31% in cash, which we are going to use probably towards buying more equity or speculative. We have a little bit of stock, which is nice, and we also have corporate bonds. But like this is our targets and stuff that we set up last episode. So we did sell the majority of our bonds, so we're good with that stuff. We want to try though to include, so how much crypto do we have? We have 4628 plus, and we want to divide that by so we have about 7% crypto, and then we have like a lot of cash, which I have plans on buying into the market today. So today we're going to be doing a little bit of what we taught, but I find it's very, very hard to keep a company in track, make sure like the capital thing as well, because like there's so many things you gotta look at when you're picking your stocks and stuff. This is just how I personally do it. So like you can see over the long term. Oh, yeah, that's one thing I forgot to put up in the slideshow. The short-term demand and the long-term demand is very, very important to consider. Like for example, like right now the auto Asia industry is not doing too well. Return on capital assets is pretty bad. So in that case, it might be a good buy because the industry is struggling. Everything is struggling right now. So like it is a good opportunity to be in the market. Like right now would be a good opportunity for oil, service, and drilling. Because if you look at it, oil prices are at $40 a barrel. That means that basically most I'm not gonna say most, but like I know for Suncor, like they make money above $40 a barrel. So right now they're only making like $4 a barrel profit, and if they make hundreds of thousands of barrels a day, that's decent profit, but that's not too great. So that basically tells them we're not going to really turn on the spigot, or we're not going to turn on the oil well. So right now people are being way too pessimistic about the commodity market. But like the thing is, you're buying a commodity. So oil service drilling is really, really good if you believe that oil is going to do well. If you want a safer play in the oil industry, you do integrated oil. Because integrated oil, they do upstream, midstream, and downstream. Whereas oil service drilling, they just do upstream. They look for the oil, they mine the oil, that's it. They sell the oil to the midstreamers and then the downstreamers. The midstreamers being the transportation, like pipelines and stuff, and then the downstream being selling the gasoline to the customer. So for insurance, for integrated oil, they do all three, so it makes it a little bit safer. So like here's a decent play, ExxonMobil, XOM. And you can see like that there's some companies in here that are very, very overvalued, like 6 times book value and crap like that. So like this one right here, COP, might be a good buy, but they are triple B and 7% return on capital assets. XOM is 9.8, and they're AA, so they probably don't have a lot of debt. So they have 8.4% bond, and keep in mind, I think they had like a, what was their return on capital assets? 9.8. So they're just making a slight spread over their bond, but they also have a variable rate debt, which is scary, and that is at 5% at the moment. So ExxonMobil might be a good buy, but they do have a fair amount of debt. But like if you look at it, they have $2.9 trillion, $2 trillion in stock, and they do have a decent amount of liquidity to either call back the bond, or they have enough to call or pay off a bit of the bank loan. They're 20 times earnings, 41 cents a share is expected. So with 41 cents a share expected, that's like almost near $1. Earnings is $33 billion a quarter. Not bad. We could also look at the payout ratio. Payout ratio is 42 cents a share. So we do 0.42. And we divide it by $1.46. They have a 28% payout ratio. So that's if their profits remain stagnant. And I'm pretty sure that's likely because like they don't have a lot of debt. They do have a decent ROE. It's pretty poor though. So I'd say it's decent, but pretty poor. They do not engage in any swaps to help counteract their interest rate risk. So this might be a good buy long term. Right now we do have a lot of stocks though in our portfolio. We had 1, 2, 3, 4. And then we have 1, 2, 3, 4. We have 4 bonds. So we could add to this position if we think there are some good deals in the market, which is interesting. SBC Communications. Let's double check on this one. I may replace it with ExxonMobil. The triple B, decent amount of debt, 1.6%. I'm hoping that they call back this bond and then they refinance the bank loan into a bond issue. But I can't do that because I cannot take over the company. So let's just use a stock screener to make sure our research is done a lot easier. I may consider buying the oil though. So we're looking for maybe at least an A credit rating. We're looking for maybe profits up in the last 3 years. We can buy some Walmart, which is like another consumer defensive stock, because if you think about it, Walmart is very, very good because whenever people are hit hard times, they're a discounter. So they sell a lot of things for a discount. So if hypothetically, if a recession happens, they're actually going to do pretty well. They do have a lot of liquidity. They can easily call back their bond and pay their taxes. They are very, very expensive price to book wise though. Low debt, great ROE, low borrowing rate, not bad. They are expensive on the price to book ratio. That's my only concern about the stock. 38 billion. Pre-tax operating margin is 50%. So the industry is probably very, 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 very hot. Like if we look at WMT, yeah, it's 4 times book. So like that's my only reason why I don't really want to buy Walmart. They are a very, very great player though in this industry. But I could buy something else, like something else that might do a lot better. Like this stock right here looks really, really good too. It's 14%, a bit below everyone else, but like they still have an AA credit rating. And they're a small cap though, I think. No, almost large cap. That's interesting. $5 billion in equity, no debt. They could issue debt right now, and ideally it would be great if they issue a bond, but I'm not going to complain. A decent dividend. Somewhat mediocre, the management. $1.70 in earnings expected. So last quarter the last few years they didn't make anything. So if we can actually look into like this stock could actually be a good play, and they're growing a lot though. That's the thing. I saw 22% earnings growth or whatever. So we go in here, company profile, cash flow projections, and you can look at all this stuff. But I mainly want to look at the capex and this right here, projected cash flow. Basically, it's free cash flow. So it's negative 200. So they're actually going to be insolvent. Like they're going to have to borrow $68 million at the end of this quarter in order to continue growing. So they're spending lots of money to grow, but I'm thinking it might be a good addition to our portfolio. Like we have 75K. We have 7% crypto. I definitely want to get the crypto up to at least 20. I could do speculation instead. Like we could cover, for example, we can cover these Bitcoin trust, or we can do like the speculative one, like I was talking about earlier, the aggressive shares one, which just buys the market index. So like they have a lot of cash right now. They have a lot of futures. It's trading a little bit above the net worth. 2% dividend, not bad. What's the management fee? 0.2% of assets. And they're buying the index. So if we look at the index is lately on a tear. So there might be a correction. So I'm probably just gonna give the inverse one maybe a little shot. So I want 7%. I have 7% in crypto. So we do 239,893. So we want 16K in crypto. I want at least 20. So we're gonna do a 13%. 0.0. I'm looking for 1.3. So we could theoretically put 31K into an inverse ETF because the market's been on a tear. There might be a bit of a correction, and we could make money off that correction potentially. So I'm thinking it might be worth it. It's probably better than not. It's probably better than going out there and actually doing it myself and doing a short, because I can't do a short in the game. You need like 400K or whatever or something in the game in order to do it. So we're gonna buy an inverse fund just for a little bit of fun. I'm gonna probably do 20K though. So we look at bear. It's a strong sell, but sometimes it makes sense to do the opposite of what everyone else tells you to do, because right now the GDP isn't doing too hot. If we look at the market's up. So it might make a bit of sense to actually do an inverse fund and make money on the downside. So we're gonna do a little bit of a downside ETF. I'm gonna probably, let's just do 30K. This is a lot of money though to be playing around with, but it is a difference. It is a little bit different than buying, what's it called, like crypto or whatever. But it is nice having the crypto. I'll probably hold this for a few quarters. You can buy 1,100 shares. So we got 30K. That's a lot of money that we're spending. How much tax do we pay? We're gonna pay. So that's enough speculation in our portfolio. Realized capital gains 26K. So we're gonna have to pay maybe 20K in tax. So I'm gonna probably do 20K in more stock. So right now we can calculate like our total like exposure through speculation. So it's 9.8 plus, I think it was about, yeah, I'm gonna do about 17,000 for Bitcoin and stuff. 46K. Divide that by, yes, so we have about 20% in speculation right now. So that's pretty high. I usually limit it to 10% IRL, but it's fine with 20. So right now we're playing with the inverse fund. So we just need to remember that we have this inverse fund and not to stay in it too long, because we want to make a quick little capital gain potentially. Because if the market continues to drop, we're going to do well with that fund. So with the rest of our money, I'm probably just going to, might make sense to do, I would buy a put maybe on a bond fund because if interest rates are rising, but I can't do options. So that sucks. We can't do that strat. But I'm going to do integrate oil because it's starting to, it's struggling a lot. XOM 9.8, decent book value. I think XOM is our winner. It's a large cap, so how much are they willing to grow? 8%. No, they're growing at 1%. So their capex should be low. Where's their capex? Capex. I forgot where. You go. Company info. My bad. Projections. So they have a subsidiary that's paying them dividends. They have some net profits, some gross dividend income. Nice. Oh, this sucks. They're not free cash flow positive, but they are still going to have a cash balance at the end of it. But the only thing I'm a little bit skeptical about is their holding. So like if we look at Mobile Corporation, we may want to look into that because that's about $1.9 trillion in one company. So they have, it's quite above the book value, and they do have quite a lot of debt. They do have a little bit of equity, which is nice. 22 times earnings, decent amount of debt, not bad dividends, great ROEs, so they're really great. Yeah, I think XOM is going to be our player for now. So we have enough speculation. We want more stock now, so 236 421, and then we're doing 40% in equities, right? What's our equity exposure? So we got about 30K right here, and then we got like 17K. So I would say like 47K is in speculation. So what we're gonna do is we're just gonna do 89,338 minus, it was like 4,700 in speculation. 42 grand we want to buy. So 42 grand we want to buy, but we also want to keep a bit of money for tax. So I'm probably gonna do like a 20K buy inside our own portfolio, maybe. 20K buy. Yahoo Inc. might be worth buying. Not too sure. Pretty cheap debt. Very, very high variable debt. 15 times earnings. That is very, very good for a tech company. Pretty high debt to equity though. A decent ROE. 32 cents a share expected. Yeah, they're not going to do as well as last year. What is the long-term industry projection? They are cash flow positive briefly. It actually might be a good buy, especially if they're reasonably competent. So I'm gonna probably do 20K of Yahoo. We could do the convertible bond, but it's likely to not pay a good rate. Like if we look at the convertible bond, I think we were getting like 10%. Right now the yield to maturity is 7 because right now rates are very low. So the price of the bond went up. Yeah, the price of the bond went up. So let's go ahead and buy up some Yahoo, I think. I'm gonna probably buy 20K of Yahoo and then pay my tax. 736. And how is the... Okay, so I'm gonna keep a bit of cash just for taxes and stuff. And once we do pay our tax, I want to ideally go into more stock. I'm thinking about buying the XOM or something. You know what? We could just buy XOM now. Yeah, I'm gonna buy XOM now. Cause like the industry is garbage right now, but it may get better. We want integrated oil. XOM. Oh shoot! It went above book value. Okay, we'll have to pay a slight premium for XOM, but I'm pretty sure there's a subsidiary. If it continues doing well, we're gonna do well with it. So what you want to do is just 20K. Bye. I can get the ask. The ask 35. So we're gonna buy 556 shares. So now we got little cash for tax, a lot of bond, and a lot of stock. And if I want to play it smart in this game, you ideally want to sell your bonds here, take home the capital gains, and ideally short bonds at these low rates. Because right now the short bond is at 1. And in this game, it usually chills around 1. I think I've seen it as low as 0.80, so it can go lower, but ideally around below 3, you want to start considering selling your bonds and actually shorting them. In the game, at least. In real life, it's a little bit different. So let's do 90. So now we got our new portfolio. And I think we're quite on target, I would say. Like we have... Yeah, we got about 54% in equities, and that's including speculation. So I'm probably a little bit overweight by bonds. Probably by like 6%, I would have to guess. Yeah, so we're about 43% in bonds right now. So we're doing okay with bonds. And it'll be also good to know where we paid for our prices of our stock. So I'm just going to expand this a little bit. SBC paid 37.05, 54. That's Ethereum, yeah. 51.47 for Bitcoin. 27.21. Oh, 71. Yahoo. And we got ultra short. So this is my inverse fund. Because like there's a chance the market can go up or down, so might as well profit a little bit off the inverse, I believe. No, it's not right. It's 25. Yeah, XOM. XL Mobile, we paid 35.99. Cool. I think we're good now. So we want to pay attention to this index. So the index is starting to flatten out a little bit. That could be a support line, potentially. That could lead to basically continue going up. Like it may have a breakout. Because like right now, like if I do a bit of technical analysis that I learned from a bit, CSI and stuff. Like right here, I would say like would be a decent support line. There's another support line over here. But like right over here is when the market had its last resistance, and so when it hit its last resistance, it went down, and then this is like it kind of looks similar to a. I think it looks similar to this. So we look at trading and stuff. We can see like this looks similar to what they call a reverse head and shoulders. So like you can see like a little head and a shoulder, and if it goes above what's called the neckline, it means that it's a buying signal. So like as you can see right here, there might be a slight chance this is a neckline. Like the neckline I think would be around there. So like the neckline obviously did lead you to a bit of capital gains. But I'm thinking that there might be a correction downward because GDP is negative and commodity prices are low, interest rates are low. So I'm pretty sure that the inverse fund is going to do all right. But we are so far wrong on that decision. Very wrong on that decision. Ultra short, 22 bucks, 20. We've lost a lot in the short fund. It's starting to flatten out. The short fund is not doing too well. We bought like 25, it's at 19 right now. If we look at our annual cash flow, expected at the end of the year, we're supposed to be making 9. And current cash balance is 6K, so we're making about 3K a year, or 11K minus our taxes. So we're making a decent amount in cash flow every year to be used towards buying the dip on our portfolio. But sadly, ultra short ETF ain't working out as well as I believed it would. Markets continue to do well. And right now you see that basically the short bond did hit 0.80. So this is the low for the thing. And in this game, if I had interest rate swaps, I would do them, but I can't. You can see that the short index is hurting me a lot right now. I've lost like 10K. But I'm pretty sure the most I can lose is 100%. Even though it's like the ETF is doing a risky strat. Like if you look at like the risky strat, they have a lot of commodity futures. So if you like look into like the, how do you see their holdings? Physical commodities, do they have any? So you can see right now that they're doing a bunch of stock indexes and stuff. So they did a lot around 4,900. So that's obviously not doing too well for them. So they have like a lot of, they're just buying a lot of the index right now. And over the long term, yeah, I regret not picking the triple one, because the inverse one actually. Okay, XL Mobile is doing well though. That's good news. Yeah, they made a good profit on hedging their stuff. Damn. Yeah, I kind of regret buying that speculative play, the ultra inverse. Should have bought the triple inverse, but right now is when I feel like the market has reached probably its top, and GDP is not doing too well. Interest rates are low, so I'm pretty sure that, yeah, it fell an extra few bucks. So I'm pretty sure this is when our play is going to be correct. Like right now it looks like we're, a bit of a correction so far in the market. A correction is like a 10% drop. So like if you look over here, this was around, I forgot where it was at. But now the inverse fund is doing well. The inverse fund is almost near break even now. And the market just fell like a few $100s. And it's hitting a bit of a support line, but it may continue falling because we're still in a bear market. The GDP is negative. If it starts hitting positive, then that's when I'm gonna probably consider selling and maybe going into the triple one. Because I'm trying to make a bit of money pretty quickly in this game because I want to be able to unlock options and try out different strategies because I am getting kind of bored of like just the simple strats. Like this is some simple strats that I'm doing. Like right now you can see that Yahoo has made some good money. So like you see, for example, 47.18 subtracted by 27.11. You divide it by 27.11, your cost basis. We made about 74%, I believe, off buying Yahoo stock. The question is, has it peaked? 31 times earnings, expected 38 cents. So it may have peaked. This is when I would probably sell a call on it or consider trimming. Like it may be worth trimming. The inverse fund hasn't made us any money though. Yeah. So that's almost in the money. These are like out of the money, but like this is a good contract that they made money off that contract. This contract they lost a lot, but like all their contracts are starting to create a bit of profit, which is good for the fund. So if the market continues crashing, this fund is going to do really well for us. And it's going to be a good short-term play, like they said. Like over the long term, and the market's going to go up on average. So it's going to make no sense to honestly sell the ETF. Oh no, it's gonna make sense to sell ETF eventually. But right now I have it as a bit of a hedge against our portfolio because most of our portfolio is long, but I want some short just to protect like our portfolio from downturns in the market. Looks like they're about to do more shorting perhaps because they have a lot of cash. So things could go down or they could go up. Either way, I'm gonna make money because if you look at our portfolio, the majority of our portfolio is long and a fair amount of it is short. So if the market continues going down, the inverse fund is going to make me profits to be able to buy the dip at. So I'm just going to chill with that. But over the long term, I'm pretty sure the market's going to do well. 25 bucks. Does it give out a good divvy? I think it does. We probably made a profit off it. I think I gave it 15%, but now it's in the 1.2. Not too great. And now you can see basically that we're going back into growth. So GDP, the country is actually starting to produce some things that are actually good. So like GDP growth is starting to happen. So when GDP growth happens, usually interest rates rise and the economy is more healthy. So I'm pretty sure it might be a good time to sell all of the short fund. Yeah, right now GDP is at 0.2. And the inverse fund is just popping off though. Like if we look at it, this is when like I think what was that, 2025? Yeah, that was when the market was at all-time lows and stuff. So if we can get another recession or whatever, that bear fund is going to make its bank. But we just have it as a hedge. And like markets look like they're probably, yeah, it looks like there's another uptrend in stocks again. Damn it, should have took the profit on that. We made like $1 or $2 in profit. You know, there's a bit of an uptrend, but there could be a downtrend. GDP is still kind of low, so it's going to take about 3 quarters. Okay, here we go. This could be some bad news that I need for my bear fund. So officials report that 2024 crime indicates are out of control, knife point. You guys can read if you guys want to pause the video, because like usually reading through these take a good minute or two. 70. Defense manufacturers reported a 72% drop in sales. Crime has been the big business in America, along with the construction and prisons and. So some industries are going to do well in this special industry scenario, like security companies and stuff. But I'm pretty sure that's going to make the economy go the pooper. No? Now I can see why they said it's short term, because like you just saw a quick rebound. How much loss? 5K? That's reasonable. And Yahoo did correct in price. Damn it, I should have trimmed. Yeah, fair enough. I've tried buying the triple inverse one and the bull one, and both of them together long term don't work. It's like dumb. So I don't really like that strat. Commodity prices are really low right now. Like, I would love to buy some gold. So precious metals and mining might be a good deal right now. Yeah, our inverse fund isn't doing too well, but every now and again when there's a bear market or whatever, I can trim out of that for a decent profit and then go into... So right now yields are rising. Like yield curve is upward sloping, so that's good and healthy. Where are bonds mature? Swire Pacific. Maybe just amount of money on that. 2029. So 2029, maybe 2042 is when most of our bonds mature. So we end the game in 2042. So that's pretty interesting. So we're just gonna hold those bonds till they mature. And we go with that stuff. I usually play much more aggressive in this game, but like having income per flow is pretty helpful. But like, yeah, my portfolio is here. The inverse fund is starting to make us money again. Cool. Yahoo just took up some profits and some BABA. Yeah. Inverse fund is doing alright. Sharp turn, decline market trend. Thank goodness. Oh, what? Bro, you said decline market trend. That should be good for our inverse. I like how the majority of our portfolio is long, but a decent amount of it is short. And the short one's actually getting destroyed now. Well, there's an uptrend, like, there's a change in trend, so SBC Communications, I'm gonna probably take a trim. Starting to hit a bit of a support line, a bit of a last resistance line. So things could go up if the economy continues doing well, or it could go down, who knows. Yeah, kind of regret not buying the inverse. Whatever. We did buy at 25, so if it goes to 25 or above, we make money. Technicals aren't being too clear on exactly what's going on. Like, there are some resistance and support lines, but the market's been relatively flat, which is good for covered calls. Like, if you're selling covered calls and stuff, like, it's pretty good if the market stays flat. But ideally, you want it to go up or down a lot over time. Because if it goes down a lot, you can get stocks for cheap. If it goes up a lot, you can sell them when they're expensive. So let's just hope that the market maybe goes to 6,000 something or 5,800 maybe, and our index can make us a little bit of money, and then we're good with that stuff. But I'm pretty sure that the index ain't doing too well. They're in the money at the moment with the options. There are some that aren't doing too well, but like if we look at the net profits, they're actually making profits off these swaps. Not swaps, money off of the futures that they're shorting. Market looks like it's going down. Could be like a bit of a triangle there, like a bit of a triangle, I think. Is there bear fund making us decent? Oh, it's decent, Diddy. Okay, are they rolling in any new contracts? Bear cash flow. Their free cash flow about 26 million. Yeah, a lot of their contracts are making money. They're selling a bunch of 5,700 though. I'm gonna be a little bit skeptical. Unless we hit like a Great Depression where there's just a giant sell-off, and then my bear fund will do really, really well. Everything else will underperform. Our stock chart is actually getting hurt too because we bought long duration bonds and interest rates are starting to hit to a point where I'm considering buying bonds. Okay, let's find a better opportunity than buying an inverse fund. The inverse funds are fun, but they're not too helpful because like you have to bet like for a big correction in order to make money off them. JP Morgan will be interesting, but the problem with banks in this game, whenever rates rise, their borrowing costs go up, and when their borrowing costs go like their deposits and stuff, they can get hurt by that. So I usually prefer insurance, but insurance is also the same thing. You just gotta make sure they have enough liquidity though and stuff. JP Morgan Chase. Banks are decent. Automotives will be good if the industry does well. Like that's a cyclical play. AXA Group I'm pretty sure is cyclical. No, they're insurance, so they would be cyclical too. The problem is they have a lot of money in bonds, and like they didn't do my strat where you sell at here, and then I usually just do consumer credit, like I'll do subprime loans or consumer loans or whatever, and then whenever rates start hitting the mid levels is when I stop investing altogether and just hold T-bills, and then around 8% on the bonds and stuff, I start doing government credit and start making good returns off the game. And oil is at $81 a barrel, so maybe worth consider trimming. Oh no, Exxon. Oh damn, Exxon did well for second there, but nope, not anymore. High grain prices, yeah. Wheat is now at $10 for wheat, $6 for corn. Corn had a like nice little dip there. Okay, I'm probably gonna take my Axe increases its dividend, increases quarterly earnings. Pretty cool. Ultra. Not too sure what to do for Orion Capital Group. Business assets. What do they do? Tire and rubber. 2 times book. Double A. Decent return on capital assets. A good amount of liquidity to call back their variable rate debt. 33 times earnings, not a lot of debt, a decent ROE. If you look over here, they're about to make $1 a share, so they're gonna beat last year's earnings, but I'm not sure about the year after. 27% growth in their capex. They are not free cash flowing, and they're putting a good $450 million a quarter towards growing. So they're gonna have they're actually gonna be at the point where they're probably gonna start borrowing money, and I don't know whether or not they're gonna provide value to me as a shareholder if they start borrowing money in the game. The index is actually going down a lot, so it's helping out our inverse fund. Our inverse fund has actually made a small profit. Long term, it might even make sense to keep the inverse fund. Like if it's in a speculative pie and you're okay with losing 100%, it may be worth keeping. But like every now and again, there's a market upturn. Like right now, there's probably going to be an uptrend. Like the index just made $100. I'm just gonna mess around with these bear funds a little bit just for fun. Made 33K. We made about 3K off that fund. Not bad. Now if I want to play with the uptrend, because like over the last few years the stock market hasn't done well, I could theoretically do that, but theoretically is not good enough. We're just gonna do an ETF just to chill. Oil might be a good deal. Oil mining stuff, like commodity prices are low, except for silver. Really, like gold prices are low. I would say somewhat silver prices are low, and so is that low, so commodities will do well. But like I want to stay away from like food companies and stuff. Like you can do financial shares, heavy shares. Real estate's pretty good. I like oil, mining, paper, and agriculture. That's pretty decent. Natural resource is pretty decent. Aggressive shares is pretty good though too, because like I'm pretty sure the market may rebound. I don't know. Okay, GDP is very hot. Like you see, us have 4%. We're just gonna speculate a little bit in there. So like I had like 30K or whatever. We're going to try out a different fund. Instead this time we're going to go aggressive. So we're going to do the bullish one, not the bearish one. So this portfolio is going to be a little bit risky. Oh, not a little bit. It's very risky because it's 3 times leverage for everything. 4% dividend, pretty great. Triple A. So we're going to go ahead and mess around with this bull one. See if we make a decent amount of money off of it. If I play the market cycle, like if I see the market go down a lot and go up a lot, up and down a lot, we can play the market cycle by using these 2 funds. And I've done it before. It's a decent way to make money in the game. But you gotta be like Mr. In and Out, which I'm not that much of a guy like that in the game. Okay, I'll probably play into 2030, and then I'm gonna call it quits for today's episode. The government has raised taxes to 26% to expand vacation time for postal workers. That's probably not too good for the economy. It's like not very stimulative. That's interesting. But that should show that the economy is doing well. Because like if they're gonna raise taxes, they have to believe that the economy is gonna do well. It's like you see that like the interest rates went up a little bit there, and our bonds are doing all right. They're likely to do all right. So I have to focus more on like the stocks, especially the one that we just bought, the aggressive one, because it's 3x leverage. And I could do leverage because after you hit 200k in this game, you can start doing leverage. But ideally, you do not want to use leverage. Ideally, you don't want. Oh my gosh, Exxon at 13. That's a good deal, man. Bull. EX. Bull. I'm not the greatest at the whole funds and stuff. Might be a good idea to buy a little bit of Exxon. About 100 million in liquidity. They did drop it though a lot. 29 debt to equity. I think they were a lot lower there. They don't have a good ROE anymore. 18 cents a share expected. They're probably going to beat last year though. They'll probably not do as well as the year prior that. Close some commodities. They borrowed 20 billion. Yeah. That makes me feel a little bit scared, and they have a pre-tax margin of 1%, so they're not doing too well with their capital assets. So the majority of these assets over here aren't being too used well. The subsidiaries aren't doing too well, I think. Portfolio. Yeah, mobile was worth like $2 trillion, and now it's worth 400k. Or like 400 billion. I'm gonna buy a little bit of mobile because it's cheap. It's a big cap company, so like it's pretty unlikely that they're gonna continue doing this crap. Who knows? There we go. We got ExxonMobil. We've lost lots on it, but we did lower our cost basis. I think from our cost basis on ExxonMobil was 35, and now it's 23. That's one of the benefits of when your stock drops, you can buy the dip, and then you can buy the stock back for cheaper, and then you can lower your cost basis. And so now, if ExxonMobil goes above 23, I make a profit, versus before it was 35. But if the stock continues falling down, and I keep buying the dip, this stock could be a big loser for us. But I'm pretty sure that ExxonMobil is going to be a great play for us in the long term. So I'm going to probably buy more Exxon. It's a relatively small play. It's for 17k versus SBC. I should have trimmed SBC though, but like they're chill. But they do have a lot of debt though, and when interest rates do rise, they have me a little bit afraid. So that's why I'm probably gonna concentrate my portfolio later on in the game more towards A companies and stuff. We're flat. The aggressive shares, we made a decent amount. Yeah, SPC took profit. Yeah, not very good for them. Oh, damn, the market fell. Market dipped a little bit. Yeah, we're not doing too well today. I'm trading like crap, honestly. Yeah, I should have trimmed. Yeah. Okay. Next time I see an opportunity to trim, I'm gonna trim. It's almost 2030 though. Once it hits 2030, I'm gonna try to grow my money over the 13 years. May do a bit more of a concentrated portfolio instead of having like 15 or whatever names, because I have so many bonds, but the bonds don't matter too much. But it's all these stocks. I want probably at least 4 at most. But right now I am quite over diversified, but it is nice because there's a slight chance that any of these names could do bad. Oh, they made $2 billion on hedging profits. Not bad. It should do well for Exxon. Yeah, an extra $2 billion, not bad. It's got $86 billion. They don't have a lot of liquidity though. They call back their bond. 33 times earnings is expensive. Decent amount of debt, not good ROE. Growing their assets by like a lot too. But oil prices are going up, so it should make them more profitable. In which they are. They're gonna beat last year by like a bit. They're gonna make like 28 cents. So I'm just gonna hold on Exxon. Maybe we're buying more. No, I want 7K, not 70. I'm kind of mad though, they're growing a lot. They shouldn't be. They're like big cap. They should just be chilling with that capital they have. They were both $659, so because we have margin. So we'll pay off that loan relatively quickly. We're making about 5K oh no, 8K without tax. But our dividends aren't too bad and our interest ain't bad either. Thank goodness we have these bonds. That way we can contribute capital towards these stocks in dollar cost average. Because right now our ExxonMobil is down big, but it may actually rebound and then it may be a great buy if it's like above, like maybe worth selling if it goes above, way above 23. Nice. We still have that aggressive shares growth one. Markets haven't really done too much over the last few years. It's been mostly flat, sadly. Right now would be a good time to do bond layering, because as you can see right now, like the interest rates are about 1% apart. When they're like 2% apart, I think it usually makes sense to do banks, because banks typically make good money whenever the interest rates aren't inverted. So when long bonds are high and short bonds are low. Because short bonds are deposits, so like they pay like short bond stuff, but like the long bond is like the stuff that they make money off of long term. But if it's inverted, then you basically want to stop investing. So right now interest rates are going up aggressively, so that's hurting the value of a lot of my companies with lots of debt. So companies that are like AAA or whatever, they're probably going to be all right. But like our bond portfolio is not doing too well. Like this Mitsubishi bond that we bought, not doing as well because basically rates are rising, which is hurting the price of the bond. Exxon's not doing too well. Yeah, they're tightening lines. Oh, it's been good for, have we actually made money off the triple? Oh, we made like a good $8,000, damn. %28 on the leverage fund, not bad. With a decent divvy that they gave me. They give me every quarter. Let's hope the bull market continues going on for a little bit. That way I can continue making profits. ExxonMobil is just going to the toilet lately. Probably because interest rates are going up. Plus they're doing a lot of investments. $47, so they're getting near my cap, and they're growing at 17% a quarter, no, a year. I mean, 6 cents. Oh, so they're not going to do as well as last year. Probably because they're dishing out so much money just towards growing their company, which they don't really need to. Gross dividends. Yeah, they're losing about $47 billion a quarter. Yeesh. Makes me want to cut my losses and walk away. But they can always borrow the money. Like they don't have. I was like, they don't have a lot of money in debt. They do have a lot of debt. Right now would be a good time to do some bonds, but we sadly haven't made too much money off our stock. I was expecting our stocks to do really well, and then I could just go in, take some profits from the stock, rebalance the portfolio, and start buying long duration bonds to do well. But sometimes, I think Mike Tyson made a dumb joke or whatever, saying that like you make plans and then someone like you make a plan or whatever, and then someone punches you in the face. So they did a reverse stock split, so that makes the price of the shares go up. So like that's why it went to $70. It's not any good news. It means that I paid $105. Ouch. Not the best thing in the world. Okay, it's almost 2030. By 2030, I want to quit. Tobacco companies to pay for damages. Yeah, now our funds lost money. Dang it. I'm doing very bad in this game. Oh yeah, Exxon's. Oh, I think Exxon's going back up. Sorta. We want to get out that aggressive growth thing, maybe. I definitely want to see why he said short term. I made like a good 20% relatively easily. Oh, he's lost hedges on oil. Damn. Yeah, we've been trading flat for a while. Hopefully the market continues to rally, and then my ETF makes me some bank. Looks like Canadian Pacific. I believe the price, the price is 125 or whatever, and then I can call back the convertible for a profit. Yeah, it's it's above par right now, which is nice. So if this bond trades for like 200 or 150 or something, I may consider trimming it, just because like it's a convertible bond. It's convertible to common shares. So right now I'm very interested in Canadian Pacific. Yeah, I should have sold SBC a while ago. We can sell Bitcoin for a good gain. I'm gonna keep that. If you look at like Bitcoin, for example, it's been on the tear lately. More losses on oil. Relatively small losses though, not billions of dollars. Oh, there we go. There goes a correction in CP rail stock. Yeesh. We're going for a bit of a bull market though, which is nice. Aggressive growth shares, we made a decent profit. Not really worth my time and effort, but fair enough. I've been holding it for a while and it hasn't really done too much. There we go, now it's actually starting to do something. 29. Oh, finally, we're actually in the bull market for once. Holy crap, it's about time. And bond yields are low, thankfully. Like, they were around, oh gosh, they were around 8%, and I was considered buying, but I didn't. And now they're at, like, very, very low levels, so. Okay. I'm thinking about selling the aggressive growth one. When it probably hits 7,500, maybe. Or, yeah, it's close enough. So let's just do some profit on our aggressive growth shares. How much we made? 32.28 minus 22.37. About a 44% return. That's reasonable. I'll sell the majority of that. We'll take home a capital gain of 10 grand. Not bad. I'll keep the rest just in case if the market continues going on a tear. It's going to give us probably a good dividend throughout the entire ages of the game. 2% dividend ain't bad. So now we got 40 grand. I don't know what to do with that money. Bonds aren't a good deal anymore, sadly. And now there's a market plunge, so I actually took advantage of that. Pretty good. Thank goodness I trimmed down the aggressive growth shares. Maybe worth buying more of, because like it's, I don't know. Bull, we sold bull around 30. It's like a decent level. It's about 21 right now. Yahoo, we finally made money on. Okay, I'm actually going to trim. So what we're going to do is we're going to do 33,087 divided by 57.03. 580. Where are they at? Decent times price to earnings though, but they're double B and they're growing a lot, so they're likely to hit more junky credit. So honestly, I'm just going to get out entirely. We took home 32 grand. Not bad. We have too many names in our portfolio. Bitcoin's alright. Ethereum's alright. Might be a good idea to buy more Ethereum. Yeah, Ethereum hasn't really done too much. It looks like it's about to do a technical thing. Like, it looks like there's a bit of a support line right here, and like it goes above right here. It doesn't really look like a reverse head and shoulders, but it looks like if it hits above over there, there may be a boom and it'll blow up in price, hopefully. So I'll probably do 20 something K in Bitcoin, Ethereum I mean. Let's see if Ethereum does well. We'll do about 20K because that's our speculation money that we made from the bull one, whatever. $20K, not bad. So what's our average cost basis? It's 51 something. Oh, Ethereum went to 45. Dang it. My technicals weren't too good there. Obviously, it misled me. Does it pay a decent dividend, though? It does. A little bit more than Bitcoin does, thankfully. Right now would be a good time to do maybe a convertible. Technically counts as stock, though. Interest rates are mid-level right now. I could get a decent... What? Oh, I see. I could have more criteria. There we go. 2040, 3%. 3% ain't bad, but if I get stock with that, that's pretty nice. But I would rather buy shorter duration for that. Is currently 2029. $2035 might be a good deal. 2% though. This is a nice junky, but junk bonds ain't too great. The other company's about to go bankrupt. Anyways, it's almost 2030. I'm gonna call it quits for today. We have to rebalance our portfolio a little bit more tomorrow, but I'm doing okay with things. It's November, almost December, and it'll be January, and then we're at the end of the episode. I bet you the bots are beating us, cause like I'm just playing like complete. I'm not playing as well as I thought I could. View recent headlines. I can do margin. You need to increase your net worth to 300k before short selling, 400k before I do options, 500k before I speculate in futures. Yeah, my net worth ain't doing too well anymore. Right now, the player who has achieved the highest is Carl Icon. In short, none too smart player. He's a contrarian. He's doing better than you are. Yeah, I need to work on my investment at the moment. So we're not doing too well with this episode, but interest rates are rising, which makes me feel like it's a little bit more competitive for bonds right now. It makes sense to save. ExxonMobil is just being a complete crappy one right now. Oh, January, my bad. Like due to CC rain, someone had to liquidate their futures, so that's why I don't like to play with too much debt. So right now we're done with the episode, and that's it for today. I'm hoping that like the slideshow helps a bunch of value, because I feel like this game there's a lot of things that cover through, and it's hard to keep up to date with everything, especially if you have like many different positions. But I find it's very, very interesting that we're doing pretty well with this series. Not as well as my bond only series or other series, but we are at the point where we're probably going to get to 1 million for over a few years, hopefully. Anyways, that's it for today's episode. Thank you guys for watching. I'll talk to you guys later. Have a good one. Bye-bye.